Ladies and gentlemen, good day and welcome to the 2022 earnings conference call of Triveni Turbine Ltd. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rishabh Barar of CDR India. Thank you, and over to you, sir.
Thank you. Good day, everyone, and a warm welcome to all of you participating in the Q3 and 9 months FY22 earnings conference call of Triveni Turbine Ltd. We have with us today on the call Mr. Nikhil Sawhney, Vice Chairman and Managing Director, Mr. Arun Mote, Executive Director, Mr. S.N. Prasad, President, Global Sales Product, Mr. Sachin Parab, President, Global Sales Aftermarket, Ms. Surabhi Chandana, Investor Relations and Value Creation, along with other members of the senior management team. Before we begin, I would like to mention that some statements made in today's discussion may be forward-looking in nature, and a statement to this effect has been included in the invite which was mailed to everybody earlier. I would also like to emphasize that while this call is open to all the invitees, it may not be broadcasted or reproduced in any form or manner. We will start this call with opening remarks from the management, following which we will have an interactive question and answer session. I now request Mr. Nikhil Sawhney to share some perspectives with you with regard to the operations and outlook for the business. Over to you, sir.
Thank you very much. A very good afternoon to all of you and welcome to the Q3 9-month results for Triveni Turbine Ltd. I trust that all of you are well and safe and that this current strain of Omicron in this COVID pandemic has not impacted you and your loved ones. To bring you to the performance of the company, during the quarter, revenue for the company grew by 29.8% on a year-on-year basis to 2.25 billion rupees. EBITDA increased by 33% year-on-year to 534 million, and the EBITDA margins improved by 63 basis points to 23.7%. And profit after tax grew 29.8% as well as the same as turnover to 357 million rupees. The higher turnover has led to a better operating leverage despite nearly 72% of turnover coming from the domestic sales, as well as the aftermarket contributing only 25.7%. This has been a true achievement by management to not only control costs, both from an administrative as well as selling expenses, but also containing all other aspects of costs, including employee costs. Raw material prices have been high, as you can see, which is reflected in our raw material percentage of sales at 55%. Typically, this is much lower in previous quarters and hovers around between 50 to 51%, and attempts are that we would get it back to this level during the coming quarters. It is also a reflection of the sales mix, where we had a higher percentage of domestic sales which carried a lower margin. The balance sheet of the company continues to be extremely strong, and the cash balance is higher than it was in Q2. The net working capital of the company continues to remain negative, and this is backed by significant customer advances, which is in excess of 244 crores on this as of 9 months. But the biggest achievement of this quarter, and something that I'd like to focus a lot of time on, is our order booking. As you, ladies and gentlemen, as you would understand, the order booking for a company like Triveni Turbines is what gives us visibility into sales in the coming quarters and coming years. The current increase in gross fixed capital formation globally is something that has contributed to our increase in sales, but more so has been our growth in our product profiles, both from the API market as well as other markets which we have grown. But more significantly is the growth in directly attacking the 30 to 100 megawatt segment. On the order booking side, I'm very pleased to share with you that the company has again reported its highest order booking in a quarter of 3.21 billion rupees. A key highlight of this order booking is winning 3 international orders in the over 30 megawatt segment from a very prestigious customer from South Korea actually, and this is for the steel segment. As you may recall, the company announced last quarter that we would be approaching the above 30 megawatts to 100 megawatt segment independently, following an amicable resolution of our joint venture with General Electric and Baker Hughes. It is extremely commendable that we've been able to make such big strides in this segment in such a short period of time. We hope that these orders will be the first of many, as the company has a renewed global focus and ambition in this segment. And these orders will further strengthen our credibility in this lucrative segment of 30 to 100 megawatts. It is important to highlight that on a 9-month basis, the company has achieved an order booking of over 9 billion rupees, which is a 40% increase over the entire FY21 order booking of 6.4 billion. This sets the tone and provides very good visibility for a robust top line and bottom line and overall financial growth for the financial year 23 and beyond. And with our healthy inquiry pipeline, the anticipated demand, we remain confident that the order booking momentum will continue in the coming quarters and will aid a sustained growth for the company beyond FY23. As on the 31st of December 2021, the total consolidated outstanding order book stood at 9.25 billion rupees, 42% higher than the previous year. And the company achieved a total order booking, as I'd already told you, of 3.21 billion rupees in the current quarter, which is the highest that we have seen, and this compares against 1.56 billion rupees in Q3 of FY21, an increase of over 105%. As you could tell from the investor brief which has been mailed to all of you, the export order booking mainly contributed to this growth. Export product order booking. The order booking in the 9 months stands at approximately 9 billion rupees, and this is a growth of over 89% on a year-on-year basis. The domestic order booking for the quarter was at 820 million rupees, which is lower by 25% as compared to last year. However, in the 9-month period, this order booking stands at 5 billion rupees, which is a 50% increase on a year-on-year basis. So domestic or outstanding order book stands at 5.05 billion rupees, which is 7% higher than the previous year. The export order booking during the quarter was at 29 billion rupees, which is 415% higher than the 9-month period of export order booking, and which is higher by 415% on a Q&Q on a year-on-year basis. And for the 9-month period, it stands at 3.94 billion rupees, which is an increase of 184% compared to the 9-month period of the previous year. The aftermarket segment has shown a growth in order booking of 500 million rupees for the quarter, which is largely flat when compared with the corresponding period of the previous year. And the aftermarket turnover was 577 million at a growth of 2% over the previous year. The aftermarket, as I have told you, contributed to 26% of the total turnover in Q3 FY22, which is down from 33% in the previous year. And so therefore, it is even more commendable for us to maintain and the order booking has improved significantly to 2.71 billion rupees, which was higher by 155% when compared with the corresponding period of the previous year. And the product segment turnover was 1.67 billion rupees during the quarter, an increase of 43% over the previous year. Ladies and gentlemen, this growth has been possible due to very active and very concerted efforts in marketing. We had not been constrained in the previous quarter to the extent that we may have been in this quarter with Omicron, but the inquiry generation that we have seen in this market has been quite commendable. In terms of the overall market update, we have seen a growth in a 9-month period in the domestic market, a growth of approximately 96% in the market below 30 megawatts and a fall of about 7% in the market above 30 megawatts. Overall, we've seen a growth in this market of about 25% in the 9-month period on a blended basis. The international market is also somewhat flat for the 9-month period, and therefore our results for the 9-month period are extremely commendable given this backdrop. Inquiries though for this current quarter for the domestic market has grown by 23%, and in the international segment has grown by 68%. This all augurs very well for our order booking in Q4 of this current financial year, as well as for the periods of the next financial year. In this current quarter, we were able to secure 27 orders in the export market. 4 from Indonesia, 4 from South Korea, 3 from Central America, 2 from South America, 1 in Bangladesh, 1 in Nigeria, 1 in Austria, 1 in the United Kingdom, 1 in the Philippines, 1 in Thailand, 4 in South Korea, 1 in Hong Kong, and 1 in the CIS countries. This breadth gives you an idea of our reach, where we have an installed base in over 75 countries and active inquiries in over 110 countries. Other aspects of the company, from design and development, continue to perform exceedingly well, and it's only due to developments on our engineering side that we've been able to offer the products into the market that our customers require, be this in terms of high efficiency blade path-based solutions on steam turbines or API turbines, or a variety of different engineering solutions that we are providing to our rotating equipment customers, both from the product side as well as the aftermarket. Our R&D in new energy or alternate energy solutions and technologies such as supercritical carbon dioxide continues to make progress, and we are on track with our commercialization and prototype timelines. The outlook for the company, given the growth that we've seen in the order booking, is very robust. We have an outlook for Q4, which would be similar to an extent in the performance of Q3, but we believe this places us in a position to really target FY23 with a very steady and sure footing of having a very robust order booking, very robust visibility in sales, and future order booking and book and bill in Q1 and Q2 of the next financial year. The board in this current board meeting has approved a capex plan of 35 crores for us to expand one bay at our Sompura facility, which will expand capacity to cater to this growth, which will be largely based on testing and assembly capacity that we need for the higher throughput, which we anticipate in the coming 2 years. This is backed by a significant growth in orders in terms of number of turbines that we will be dispatching, as well as the megawatt capacities. The board will also look proactively at partnerships with local service companies who already associate with us, so as we can improve our sales on a local basis and improve our presence and our visibility in front of our customers on a very proactive basis. With that, ladies and gentlemen, I'd like to open the floor for questions. So back to you, moderator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ravi Swaminathan from Spark Capital. Please go ahead.
Hi, sir. Good afternoon. Congrats on a good order inflow.
Sorry to interrupt, Mr. Swaminathan. May I request you to come on the handset mode? The audio is not very clear.
Is it better now?
Yes, I can hear you.
Yeah. So first of all, congrats on the robust order.
Thank you very much. Thanks, Ravi.
Continued over the third quarter also. Can you talk more about the international markets? How quickly are those markets expanding? Which geographies are seeing good growth? What is driving growth? What has changed this year vis-a-vis last year? And then on the domestic market also, if you can give some commentary. This quarter, it has been slightly soft in terms of order booking in the domestic market, but I recognize that the 9-month numbers are still up. So if you can give commentary on the domestic market in terms of segment-wise also will be great, both international and domestic.
Yes. I'm going to get in Mr. S.M. Prasad, who can comment a little bit more in terms of where he's seeing visibility on the orders. But before I get him in, I'd like to say that the export market, like I told you earlier, in the 9-month period has declined by about 7% on a year-on-year basis. Even though we may not, but this is based on what we are seeing as coverage. We do not have full visibility in the export market. But despite that, we believe that we are increasing our market share as we move ahead. On the domestic side, we maintain our market share at historical levels in excess of 50%, and so therefore that is something that we aim to maintain. We'll continue to work towards. Where we see demand from a segment basis is typically in the area that we've spoken about in previous quarters. One is, of course, the renewable energy demand from biomass-based IPPs or solid municipal waste incineration plants. And these largely we see in countries of Europe, city-states like Hong Kong, and certain more developed countries where there's a focus on renewable energy. But we've also seen an uptick in gross fixed capital formation in industries such as cement, waste heat recovery, steel especially. And this is similar not only for India but international as well. So we are seeing similar, and this is where you have international pricing of hard commodities which are easily tradable. The capacity constraints are known globally. But I'd like Prasad to come in to give you a little bit more visibility, because what's important is that we are seeing this continue. This is built up already within having seen 1 month of Q4. But the visibility that we have coming into order booking for FY23 also is equally robust. And we believe that we should be able to sustain this level of performance of order booking on average in the next coming year as well.
Got it.
Prasad, if you could come in and give some visibility, please. Prasad, are you on the line?
I would request members of the management on the landline to unmute your line, please.
While I think that they come online, the market is very broad-based, Ravi, from an international perspective. Like I told you, we received 27 orders this current quarter itself. And they do stem from steel. Like I told you, this is very prestigious order for us because steel is a large capacity market and something that's seeing a growth not only in India, but in all markets where they do have capacity. So we see that as a positive for us, not only in terms of being able to provide high technology solutions, but as soon as we have a higher export as percentage of sales, our margins on those products are significantly higher and in excess of double of the domestic margins. And so we're happy when we're able to see good export offtake. This is also backed by good customer service order intake. And we see that not only do our spares and servicing offer good growth opportunity, but our refurbishment, where we are providing solutions for rotating equipment on a broad basis, as well as third-party aftermarket solutions, continues to grow as we expand our presence into local markets.
Got it, sir. Got it.
Prasad, are you there now?
Yes, sir. We are there now. We connected back.
Yes, please. Can you answer Ravi's question with some visibility?
Yes, sir. I missed the question.
The question is about how you see the visibility of orders, both domestically and export.
Yes, sir. Yes. So the visibility from the inquiry pipeline wise on the domestic, we have a good traction. So especially from the industries like cement, pharma, steel, and distillery segments are dominating the inquiry pipeline. Even our order booking also, the spread is from similar segments, domestic like steel, pulp and paper, palm oil, waste to energy sort of a thing. Especially international inquiries, we have a good order booking as well as the inquiry pipeline from steel, then waste to energy and waste heat recovery based cement applications and distilleries and food processing. So based on the inquiry pipeline, as we mentioned in investor brief about the increase in the inquiry pipeline, so we are quite bullish on that thing for the next year and next quarter also. And over and above, the offering product basket is increased, means with up to 3200 megawatt increase apart from the API inquiry pipeline. So with that, we are quite confident for Q4 as well as FY23.
Got it. My second question is with respect to the margins. You had already touched upon, sir, Mr. Nikhil, so we have received orders both in terms of exports and also in the higher rating, that is 30 to 100 megawatt. And historically, as you had mentioned, the margins in this are much, much higher than the regular margins. So at a blended basis at a company level, so what might be today as 20% EBITDA margins? Can we see 300, 400 pips expansion over the next couple of years because of this high margin orders?
So, see, Ravi, you track us, so it's difficult from a quarter-on-quarter basis. But if I look at a year-on-year basis and give you a little bit of a greater insight into that, domestic margins are much lower than our export margins, and so therefore the percentage of sales that we have from export will of course contribute more significantly towards margins. And equally is the contribution of aftermarket in general, be that domestic or international, that doesn't make a difference. That contributes more significantly towards margins. Also, there is a question about operating leverage and the fact that the higher our turnover is, as you've seen this quarter, this is a very good quarter to analyze that where we have seen the impact of increased raw material pricing. For example, we've seen our high chrome ingot pricing increased by over 50%, 55% in the last 6-8 months. And so these are impacts that we have to take. We work with our suppliers for long-term contracts, and we have to live with them. So it's not as if we have to live with them when they have price increases, but when prices fall, we also take the benefit of that. But in this current quarter where we did see price increases, that was limited to an extent of only 55% of turnover, despite the fact that we had a product mix where you had which is heavily skewed towards domestic sales. Arun Mote can provide a little bit more insight into our initiatives to ensure that we at least maintain the margins that we have right now. Arun?
Yeah, good morning to you. As you know, the margins at the sales level depend on the raw material and other expenses. The raw material, our supply chain is a very well-oiled machinery, and we have suppliers who have been dedicated for years together. We have been working with them for the last 30, 35 years. Many of them are our employees. So we are continuing efforts with them and also independently to lower this material costs. We are sitting with them, helping them negotiate their raw material costs to ensure that the overall subcontract products which come to us are at a competitive rate. We are value engineering and some of their sub-assemblies. We are sharing with them the cost benefits that they get and we get. So all these exercises are going on, and our intention is to ensure that the input cost, not only the raw material, but the input cost for the final assembly comes down. And we have been pretty successful, as you know, from the past records. We expect that in FY23 and 24, we will continue to do the same thing, because we don't expect the raw material prices as such would come down now so quickly. If at all they come, there will be some kind of leveling off.
Got it.
Question to you?
Yeah. Thanks. And my last question, sir. So, our order book has grown year on year almost like 40%. Next year, at least 20% kind of growth is something that is there on the cards?
Actually, our ambition is for higher than that, because we're seeing good visibility in all our segments. You see, what we've historically seen with Triveni Turbine has been the below 30 megawatt segment. And while that has seen some growth based on higher fixed capital formation, it is really the contribution of two other market segments, which is the API market segment, which made a very small entry into, and it's a competitive market, it's a high margin market, but we believe that is a big growth market for Triveni Turbine, as well as the 30 to 100 megawatt segment. So all of this leads us to have confidence that we should be able to maintain a good order booking runway, which will ultimately contribute to turnover.
Got it, sir. Yeah, thanks a lot.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants, we would request you to please limit your question to 3 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Harshit Patel from Equirus Securities. Please go ahead.
Hi, good afternoon, everyone, and thank you very much for this opportunity. Sir, my first question would be,
please come closer to the phone.
I can hear it all right. Thank you.
Okay, thank you. Please go ahead.
What would have been the market size in India for less than 30 megawatt steam turbines for the first 9 months of FY22? And why do you see that going for the full year FY23? That would be my first.
The market, the market in 9 months has been approximately 800 odd megawatts. We anticipate that we will end the year with a proportionate growth as we've seen in the first 9 months. This is approximately, like I had said earlier, about a 90%, 96% growth year on year. But the larger market size of 30 to 100 has seen a decline in India. So on a blended basis, because now as a company, since we market overall up to 100 megawatts, we've seen a growth in the market of about 25% only. And we believe that this will continue. This is something that the order booking, the inquiry pipeline estimates has been quite robust. And so we think that this will continue. We see no reason for it to fall. There's ample liquidity. There's good momentum in terms of people willing to place orders. There seems to be some hiccups will happen with COVID here and there, but largely I think that we're quite bullish.
Secondly, on our very strong order intake in the first 9 months, so how has the pricing moved both in domestic and the overseas market? So has the entire growth come from higher volumes only, or pricing too would have played a part over?
No, it's been mainly a volume growth. Pricing plays a role, but you see, it's very difficult to say since we make a engineer-to-order product, which not only changes in terms of configuration of the steam turbine itself, but auxiliaries and the balance of plant which go along with the steam turbine also change in terms of scope. So in general, pricing would depend on how the contract is framed and what the customer wants to place the order for in terms of scope of supply. The margins is a better question to stick on because that is something that is predefined at the time of us closing the purchase order. And what we've seen there is that there has been some pressure from a raw material price perspective in terms of order booking margins, but that is mitigated with a lot of the efforts that Arun had talked about in terms of being able to value engineer, work with suppliers to reduce costs once orders are placed, to ensure that we at least maintain our margins going forward. This is despite the fact that having a better product mix in terms of execution, which may happen in the coming year because of a higher percentage of exports as a percentage of sales, will contribute also favorably towards our margins.
Right, sure. And so, lastly, out of the 9 billion rupees order intake for the first 9 months, how much would have come from API and the 30 to 100 megawatt segment? And where do you see that going?
I don't think we're going to be giving those data points because it's competitive to a large extent. But suffice to say that we're seeing that the API segment is not large enough for it to be reported independently. 30 to 100 megawatt, just because the size and capacity of these turbines are larger, they would of course be of higher value, and so therefore they would contribute more. In this current quarter, the 30 to 100 megawatt order that we did talk about at the beginning of my introductory remarks did play a disproportionate role in terms of the value. But we believe that this is a market segment that we're going to be approaching and trying to get orders on a every quarter basis. And so they need to start distinguishing between different market segments will be very difficult for us to do.
Understood, sir. Those were my questions. I'll come back in the queue.
Thank you.
Thank you. The next question is from the line of Ahmed from Unified Capital. Please go ahead.
Thank you for the opportunity, sir. I'll break down my question into exports and domestic business. So, sir, on the export side, there is pickup in the more than 30 megawatt segment, and considering GE has exited, can you please give some light on what kind of challenges we are facing maybe on the technical side, And definitely on the other side, there is a lot of help in terms of doing business with more independence. So in that context, can you help us gain understanding on how we are gaining traction so quickly in the 30 to 100 megawatt segment?
Okay. Let me answer that question in a different way, because I really don't want to answer it based on GE, because very frankly, I have no comments on that aspect. But suffice to say that when we were, and you've been following the company, so you know that the joint venture ran a certain way and it had a certain performance. We were always, our expectations were that we could have done better. From a technology perspective, Triveni's technology is world leading. Our efficiency levels, our cost levels, our supply chain, bar none, second to none. So very frankly, we have all confidence, and the JV in its execution, it executed 50% of its orders on Triveni technology. So very frankly, we've had confidence in our technology for a very long time. We have an installed base already in our technology. So it's not as if these orders can come based on anything which is not founded in practical installations. So that was so from a perspective of technology, we're extremely confident. But on a general market basis, we need to continue with our developments to ensure that we continue offering our customers the most efficient steels, blade parts, and whatever other configurations they may need in terms of injection or extraction for their applications. As you know, Triveni Turbine is a provider of both heat and power solutions, and so when it comes to those requirements, we are very aptly placed to be able to provide solutions to both industrial as well as renewable energy clients in all market segments, below 30 megawatts, above 30 megawatts. I forget your second question. Can you just repeat that?
This was the main question only. The second part is, how will the margin profile of this business differ from our current business, 30 to 100 megawatts?
No, margin is not different. It's a question of domestic versus international. International tends to give us over double margins than domestic margins.
Okay. And what has been the key reason why we have been able to gain the traction in this market so quickly? Like, I think in last 3-6 months only we have got this sudden traction. So what are the specific, any reason, or it is just that, yeah?
No, the reason is that the team is raring to go. So we have great confidence in our ability. Our sales network is very primed to take these opportunities on. We have our performance in the below 30 megawatt space is last calendar year we were number one in the space in terms of number of installations, and so therefore this easily translates into confidence above 30 megawatts also. And we have the appropriate product and the appropriate pricing, so there's no reason for us not to go and be aggressive in getting these orders.
Okay, thank you, sir. And just one question on the domestic side. When we say we cater to the steel segment, so is it sponge iron, or which part of steel sector do we cater to?
Prasad, can you answer that question, please?
Yes, sir. Yes. So we cater to both sponge iron, pig iron, as well as the integrated steel plants. So in that also, again, kiln gases, blast furnace gases as a waste heat recovery. So across we cover the complete integrated steel plant segment.
So a majority of these applications are for waste heat recovery from the steel segment, much like it is happening in the cement segment as well, where we're seeing more growth on brownfield expansion than greenfield expansion to lower cost of production.
Sure, sir. Thank you. Thank you.
Thank you. The next question is from the line of Ankit Babel from Shubhkam Ventures. Please go ahead.
Yeah, good afternoon, sir. So you did mention about the fact that the current momentum, mainly from the order inflow side, can continue in the coming quarters and even in FY23. So, sir, just could you just give us some more idea about, so suppose if you end the current year at around 1,200 crores of order inflows, if you, if Q4 is similar to Q3, so if you end up somewhere around 1,200 crores order inflow, on that base also, can you grow at 20-30% in terms of inflows in the coming year, is what you are trying to say?
Well, our attempt is that. We have to wait and see. The fact is we're setting up our capabilities and capacities. I think, Arun, maybe you could talk a little bit more in terms of what the plans are for the company in terms of recruitment and international expansion, etc., so that we get more visibility into how it can cater to these market segments.
Yeah. One is about the plant capacity, which Mr. Nikhil Sahni has already explained. We are going for an additional bay that would substantially augment our capacity, and we should be able to meet much higher levels of numbers as well as megawatt production. That's already on the way, and you would see it soon completing. As far as HR is concerned, due to COVID, we missed one batch of graduate trainees and the initial hires, which we have already done now, and those people will be available. This year again, we will be running the batch of graduate trainee engineers and diploma trainees so that they would be added. That would be at the initial starting level. Then we are looking at some senior persons joining us from within as well as from other engineering industries. And we are looking at sales people who are across engineering industries. Some of them have joined and some would be joining, including different nationalities as and when the time comes. So the HR.
I think the point, the point is that we have a very aggressive HR plan to be able to add capacity so that we can cater to this growth. This is something that we have to invest into. The sales don't come just by themselves.
So just a ballpark idea again, sir. So are you looking at somewhere around 1,400 crores of revenue by FY24, given the current momentum in inflows and execution?
We don't really give visibility like that, but I think the numbers are something that we believe are achievable.
Okay. And so my second question is, what is preventing you to get good orders from the API segment, since you already have all the building blocks ready from the product approval to the infra and everything? So what is preventing the scalability in order inflows in the API segment?
It's nothing preventing us. It's just a question of those orders coming up for execution. There's a degree of fear from customers about Make in India. And so that is a hindrance that we have to overcome, which we've tried to do in the steam turbine and the power generating side, PG side, for quite a period of time. But we will overcome this slowly. We have a small market share right now in a very large market, and we think that we can continue to grow on that. But Prasad, would you like to provide a little visibility as to how we're attacking API?
Yes, sir. Yes. So API-wise, yes, we have a strong inquiry pipeline, and our acceptability is there by all international consultant, EPCs and OEs. And by seeing the inquiry pipeline built up and our acceptance across the globe, so we are quite bullish on API segment. But API segment order finalization time cycles are quite large, because even though the end customer, like a refinery finalizers, are OEs, so there is a little time lag there. That is the only time lag issue. But next quarter or coming year, we'll see API a good contribution in the overall order booking there.
And the margins in that segment is again in line with your export margins?
Yes, yes.
Okay.
Yeah, so it's a lucrative segment for us, but we also, what will contribute to our growth as we move forward is also our aftermarket. And Sachin, maybe you could add a little bit about how you're seeing the growth in the coming year in terms of order booking and what are market segments.
Yeah, good afternoon. We are seeing very good traction on inquiry generation in both domestic and export markets for customer care. The aftermarket business, we are hopeful of substantially increasing our order booking in the coming quarters, including next year. There are many efforts we are making in this regard. We are adding our resources on the ground. We are increasing our presence overseas. and we believe that closer collaboration with our execution partners overseas will create more value for this.
Okay. And so my last question is that the cash balance has been increasing continuously in your balance sheet, and in last quarters you had mentioned that you look into either utilizing that cash internally, and if you don't find any such utilization, you'll pay it off so that the return ratios and all those are not impacted.
I don't think we said that, because what we did say is that the board hasn't taken any decision, and unfortunately it's still at that position where the board hasn't taken any decision on capital allocation.
Okay. But
sorry to interrupt you, Mr. Babal. I would request you to
let the question continue. It's all right.
Okay.
Yeah. So is there any inorganic opportunity possible in your segment?
Well, to answer that, I mean, of course there are opportunities, but is it something that we would consider is a different matter. We believe that we are at a technological level where no inorganic opportunity is going to help supplement our technical capability. So really, we don't think that is a direct route for us to grow on a big way. Smaller opportunities that may add capabilities, which may not be very expensive, is something that we may look at. But I think we board hasn't considered anything concrete right now.
Okay, sir. Thank you so much. I'll get back in the queue if I have more questions.
Thank you. The next is from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity, and congratulations to the management for a very good performance. So my question, Nikhil, is that last 2 years have been very difficult for most companies, and for a company like us, which has a larger share of exports business, do you believe that there is a requirement of additional feet on ground, both in terms of sales and in terms of installation? I think Sachin did speak about hiring additional resources, but not sure whether it was international or domestic.
Sorry, can you, the question, do we need to, what is the need for adding resources and capacity? Is that the question?
No, in terms of more feet on ground for sales and installation in the international geographies, because travel restrictions have been very frequent and long.
Definitely. You know, the fact is that we need to hire people who not only have a greater local connect, who have relationships that they come with in existing geographies and things. And so therefore that is very much part of our very immediate plan. It is not a way to de-risk, it's more of a way to actually expand growth opportunities. And we have had some success with this, and we think that is a good way for us to grow, both from a product sale perspective as well as from an aftermarket capability to be closer to customers. So both will be required. But to that extent, we have budgeted all of these as costs, and we still assume that our margin expectations will be consistent.
Okay. So on a year-on-year comparison, we see that your raw material to sales have risen to 55.3 from shade lower than 50. So what percentage of this, in your view, has contributed due to a mix change, more domestic, less of an aftermarket, and what percentage is actually impact of the input cost inflation? And are you actually seeing that in the orders that you are getting, you are able to mitigate this and go back to the raw material to sales level of 50% that we were seeing in the previous years?
That's a very difficult question that you've asked because, again, as I think another one of your colleagues had already asked, our sales is dependent on order intake, and which because it's because of the vagaries of the market, you don't know if it's going to be international, domestic, or in which quarter things are going to be dispatched. But in general, when we are accepting orders, we have a good idea as to the cost that will be incurred on executing that job, because of either long-term contracts that we have for certain supplies, long lead items such as casings and castings and the forgings, or certain balance of plant equipment that we routinely buy. And so we have a good idea when we get to the negotiating table where prices lie. As you'd imagine, the number of components that go into steam turbine, both in terms of the plant-to-plant steam turbine itself, as well as the larger balance of plants, which include the generators, gearboxes, panels, electrical systems, blue ball systems, etc., will all get impacted by higher commodity prices, especially steel and copper. And so to that extent, there is most definitely going to be an impact in terms of the costs that we have incurred. I think what Arun had alluded to earlier also is that while these prices may soften a little bit, it's difficult to imagine that they will, or we're not budgeting as such any steep increase from here for going forward, but neither are we budgeting any steep fall from here going forward. So as it currently stands, when we are negotiating for orders, depends on the competitive intensity of that order itself, but we try to maintain the margin level and the strategy that we have in terms of market share and market dominance within different segments. But as we currently stand, the order book that we have is consistent with our historical margin profile, which gives us visibility in terms of once we execute these orders, we will be in a good space in the coming quarters and years.
Sure. Just third and the last question from my side. We have seen about 90% increase in the order flows in the 9 months, and with the lag, we will see that translate into revenues. Could you speak about your supply chain? Because globally, all across industrial companies have been talking about supply chain bottlenecks, and especially on the electronics and the semiconductor side. And are we seeing that our supply chain is geared to ramp up so quickly?
Okay. I'll just ask Arun to comment on that. But our supply chain is broken up into 2-3 components. One is subcontractors, which would do part work and machining, etc., which allows us to have less capital employed on our balance sheet and get them to do dedicated work. The rest are vendors who may actually do some more value-added work, and the others will be suppliers who end up supplying their product directly to customer sites. So Arun, could you give an idea in terms of how much are local and how much do you depend on foreign supply chain for this?
Yeah.
How we are catering to growth?
Yeah. Yes, our foreign supplies are always less than 5%. And the semiconductors and the printed circuit boards and the other circuitry, that electronic circuitry that you're talking of, doesn't affect us much because that percentage is lower, and that is taken care by the equipment supplier like governors, like other control instruments. So they are the people who have to manage it. In the last 1.5 years, we haven't faced much difficulties from any of them. And as far as the domestic supply is concerned, it's perfect, more or less perfect. We haven't had any issues. Whenever we had lockdowns and all, of course, there have been logistic issues and supply chain issues. But we have all overcome them, and our production is absolutely normal.
Okay. Actually, the question was that the 90% growth we have seen in the orders, we might see 30-40% growth in the revenues or execution in the coming quarters. So is the supply chain okay to ramp up at such a fast pace?
It's already done. Because we have been seeing this trend for last 6 to 8 months. So adequate steps have been taken. We are already on the expansion mode as far as various capacities are concerned, and it will be an ongoing exercise for next 3 to 6 months. So it hasn't happened suddenly. We have been foreseeing it.
Sure. Okay. Yeah. Thank you so much for taking my question and best wishes from my side.
Thank you.
Thank you. The next question is from the line of Nilesh from BOI AXA Mutual Fund. Please go ahead.
Hi, good afternoon. Thanks for the opportunity and congratulations on a great set of numbers. So my first question was on this 3200 megawatt category. So few questions on this side. So which are the industries we cater to in this segment? And what gives you confidence that going ahead, the growth in this segment will be way higher versus what we had seen earlier during the GE era? And third, on this part itself, how aggressive is the Siemens or any other large player in this segment? And what would be their market share and what we envisage to capture in the coming years?
I'll start from the reverse to give you a better idea. I think the market is dominated by large multinational manufacturers like Siemens in this segment. The market segment, both domestically and internationally, is a little bit higher in the 30 to 100 megawatt segment. In India, it's slightly lower in the 30 to 100 megawatt segment than below 30 megawatts. And this is really the profile of the customers and the industry that we cater to. The larger the industries are, the higher the capacity of the requirement for both steam and power will be. The largest requirements, of course, comes from metal and steel, which is for their main power consumption. But when we look at it from a perspective of all the gases that emanate from a waste heat recovery perspective, that is a market segment that definitely is about 30 megawatts. We see very consistent demand in chemicals, both in India, where we have orders also in the chemical segment for higher than that capacity. You have paper and pulp, which require high extraction, and large paper companies also have placed orders on us in this market segment. You would not see large food processing distilleries, etc. in this space. You would see waste to energy as well as biomass-based IPPs in this market segment. And so this is similar to the market segment that we cater to below 30 megawatts. And we believe that our sales network, etc., is something that is capable to go out and leverage this in an aggressive manner. So we will be aggressive here to gain some market share. But our cost levels also are quite robust, so that we think that we'd be able to maintain margins despite the fact that we would be aggressive. And I don't want to go back into the performance of the joint venture. That's something that's over now. We believe that our ambition is to outperform whatever we did perform under the joint venture.
Okay.
Does that answer your question, or would you like more clarity on certain things?
So I would like to have more clarity on, so one is the addition of sales force, etc., to drive that 3200 megawatts. But the piece was there with us earlier. We had confidence of international business coming to us via tie-up with GE. So everything was always there on the platter. And I guess the sales were flat for quite some time over there. It could be the market not growing or whatever the reasons could be. So now going ahead, apart from Salesforce, what is the one or two thing which you would like to highlight where, okay, now I can see a 20 or 30% growth from here or whatever number it is, but what gives you that confidence you will grow at a higher pace versus the last 3 years or 5 years?
Well, the main thing is that we start from a low base. But besides that is the fact that, now I have possibly to go back and explain how the joint venture worked, is that international sales were handled by our partner, and we handle domestic sales as well as certain sugar orders internationally. What we find is that the focus that we have in the market, and given our structure of sales, which is aided by an agent network which has deep-rooted connects and relationships with customers, aids quite considerably in being able to not only firstly get visibility into the market in terms of where the orders are, but then to be able to go and aggressively close those orders. So the structure is different also, not only the number of people. And also the focus. The focus is the most important thing. Because it wasn't like as if earlier we were losing, if we didn't have visibility into orders, then we weren't quoting into those orders.
Okay. Got it, sir. That's helpful. And second question was, say today we do capacity of say around 700, 800 megawatts. and say FY23, 24, considering the growth in the market and we have demand for 1.3, 1.4 gigawatt, with the current capacity, are we in a position to cater to that demand, or we'll have to do incremental capex?
Arun, can you answer this question?
You see, we have built in a flexibility to expand our works quickly and augment the supply chain. So we will always be making efforts to see that we have at least 10 to 20% of the excess capacity, because this capacity doesn't cost extra. So we will have some breathing time in case there is a sudden spurt of order, and we should be able to take on more orders in future. We are pretty flexible on it. I don't expect much of capacity issues if the market suddenly goes up.
I think another thing that you should keep in mind is the two capacities that we have to talk about. One is the capacity that we have in-house, and as you can see from our balance sheet, that really what Triveni Turbine does is it manufactures the high-value IP-sensitive components in-house, and then it does a lot of assembly and testing and quality control. And so the capacity that we have internally is for quality control, testing, assembly, etc., is what we will be adding on at this point in time through our capex proposal. But equally from the manufacturing side, we need to ensure that our vendors, subcontractors, etc., have capacity as well, and that we monitor to ensure that they have at least 50% extra capacity from what our requirement is. Is that fine? Can we move on to the next question if you have time?
Thank you. The next question is from the line of Hiten Boricha from Sequel Investments. Please go ahead.
Hello.
Hello.
Yeah. Thanks for the opportunity, sir. So my question is again on the capacity addition which you highlighted earlier. So just wanted to understand, can you throw some more color, like what is our current utilization and by how much we are looking to expand our capacity?
See, again, like I said, we will be expanding the capacity in terms of volume, monthly volume output by about 33%. But this is more from a testing, assembly and testing perspective. What we believe is that this affords us ample growth in capacity to deal with the vagaries that we may require in terms of our customer expectations of dispatch in any particular month. So we will. So very frankly, our capacity utilization is, if you take the number of machines, but number of machines vary very drastically in terms of value. So it's difficult to put value to capacity as a metric here. But number of machines wise, we have the capacity now to do. I would say, Arun, can you give an idea as to how many machines could we do and how many have we taken it up to?
Machines per year, or you can say per month. We have a capacity to make 15 machines a month, and it is flexible. About 5-6 machines can be added easily. But with this expansion, we will be closer to about 20 to 25 machines. That's what we are looking at.
Okay. So what kind of capex we need to spend on this?
We already said, Nikhil Sania has told
35 crores is what the board has approved.
Okay. And so one last question. What capex we have occurred in FY 9 months FY22?
How much is that?
The capex for 9 months is 12 crore rupees.
12 CR for 9 months. Okay, sir. Thank you.
Thank you. The next question is from the line of Bimal Sampath, an individual investor. Please go ahead.
Hello.
Yeah, good afternoon. Most of the questions have been answered. One is just one or two small things. One is on the cash side. So now when do we expect in next year, FY23, some action? Do we expect something in 23? And second is on this 30 to 100 megawatt capacity. turbines, I mean, how is, total market size compared to our 0 to 30? Is it double? What is size of that market opportunity?
So the opportunity from macro data sets that we see is approximately 1.2 times internationally than the below 30 megawatt segment. In India, it's about 80% of the below 30 megawatt segment. This is a general trend. Of course, our visibility into the international market is not fully there, and so we don't participate in that full market. But our attempt is to get there consistently. On the cash question, like I had mentioned to another one of your colleagues, is that the board hasn't taken any decision. We're cognizant of the fact that this dampens our return metrics, but the board hasn't taken any decision. As soon as they take a decision, we will inform you.
Yeah. And just one last, what we see with a 35 crore capex, we will be able to expand our capacity by 33%. So the way we are growing, I think in next 4-5 years, we will be at least 3-4 times in size. What is your perception, sir?
No, I think let's stick away from those type of conjectures. Our attempt is to grow consistently and to ensure that.
No, because see, we'll have 30 to 100. Earlier we had only 0 to 30. Now we'll have 30 to 100, then API, and then the supercritical, etc., etc. So the addressable market will. Yeah, but I'm talking of 4-5 years down the line. Our addressable market will shoot up.
3-4, then you say 4-5. So I think the fact is, regardless of our order book visibility that we have coming into FY23 and for FY23 itself also is quite robust. And I think we've given an indication as to how we look at that. Looking more forward from there is dependent on so many other factors that it may form maybe a little bit of conjecture. Our efforts are on strategically to aim to grow this market and have greater participation. So I think I wouldn't like to answer the question.
Right. No, thank you. Thank you very much. This is more than this gives a good clarity. Thank you very much.
Thank you.
Thank you. The next question is from the line of Ankit Babel from Shubham Ventures. Please go ahead.
Sir, just a follow-up. Given the large opportunities which are now present in the overseas market, where do you see the share of exports revenues in your total revenue in the next 2-3 years time frame?
First, let's look at it in terms of order book. We aim in FY23 to take it back up to 50%, so that will then reflect onto sales.
Okay. But do you feel that structurally the share of export will only increase given the opportunity sizes available in the overseas market and once the order inflow traction also comes in the API segment?
Yes. India is a large economy for this, in terms of fixed capital formation right now. So, so we can't disregard that fact from a global perspective. But the global market is larger than just India. And so we have always been very optimistic in terms of growing our presence internationally. We did have some hiccups a couple of years ago in terms of hitting a ceiling, but we think that by adding human resources and other means by which we can get closer to customers as well as expanding the addressable market, that this percentage should go up.
Okay. And so lastly, ceteris paribus, assuming the raw material prices move in a range-bound manner in the coming years, and assuming that your share of exports is at around 50%, which you are targeting. So in that scenario, considering the operating leverage which you would be having with the growth which you are envisaging, so in that scenario, where do you feel your operating margins to settle at? Would it be like in the 23, 24 range, 25, 22? Where you see that in that scenario?
You see some things that our aftermarket is also growing quite consistently, and so that has a good contribution to us. We will incur more overhead to have an increased order book, so that will then be compensated by higher turnover, and so this operating leverage will also get utilized to an extent. We think that from a product side, getting an order and then having the life cycle value of that customer is extremely beneficial to us. We get spares orders from customers over a period of the life of the turbine, which can be as long as even 35 to 40 years. So this is something that very frankly, our competitors who have lower cost of capital end up using quite strategically to be able to just acquire customers. We, of course, look at them in distinct P&L. We have a higher cost of capital in India, and so we need to make margins on these sales. And we've been quite consistent in showing these margins. What the end result is in terms of the EBITDA margin, we try to maximize that to the extent possible. But the competitive intensity changes quarter to quarter. But having said that, our cost structure is very good. So overall, if I give you a general outlook, we think that we're comfortable at these margin levels that we're at right now. We think that given the sales mix that we may have next year with higher export as a percentage of sales than this current year, some of the pressures that we may have had in terms of raw material increases or higher overhead won't be there also. And with higher turnover, we're quite optimistic. I think that without giving you, I'm giving a very roundabout answer, but I think that's all I can give at this point.
Okay, that's helpful, sir. And sir, just one more small question. So the growth in aftermarket in the coming years would be in line with your, growth in order inflows in the aftermarket segment will be in line with your overall order inflow growth? I mean, the share will maintain?
I think we're more optimistic on order flow increasing in the coming year from the aftermarket in FY23.
Okay, that's helpful, sir. Thank you so much, sir.
Thanks, ladies and gentlemen. That was the last question for today. I now hand the conference over to the management for closing comments.
Thank you very much, ladies and gentlemen, for joining this call. Sorry for running over a little bit. I'd like to just leave you with the fact that we at Triveni Turbine have weathered this Omicron pandemic quite well. Omicron lockdown. Everyone on this call has actually, I think, already had it, and we're quite confident in terms of being able to show the results for this current year and the coming years. Thank you.
Thank you. On behalf of Triveni Turbine Ltd, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.